All right, I just want to do say an update on the financial banking, what would kind of look like a few months ago, like it might be a financial industry crisis, how things have settled out, and then answer this question: are we done? Are we kind of past the worst of it, and can we kind of go back to normal or a new normal? So let's talk a little bit about context here. First of all. There are three banks. I've got four listed up here, but the first one, Washington Mutual, the biggest bank failure in American history. Just to give you an idea, by the time it failed, 307 billion. It was a little bit bigger than that before then, but bigger than these current these three bank failures that we see that have occurred this year in 2023, and the most recent becomes the number two, so First Republic Bank, and about 100 billion, a little less than 100 billion smaller than the 2008 failure of Washington Mutual. But the number two, three, and four largest bank failures in American history are the ones that happened this year. So in trying to answer this question, are we done? I think it makes sense to understand what was behind the failures. Now, in comparing 2008 to 2023, it's like part of it is just kind of the overall scale and scope. There are 26 banks that failed in 2008, and there are three that failed in 2023, and really nothing obvious on the horizon right now. So sometimes banks fail. It doesn't mean that there's not going to. There certainly will be others at some point in the future, but in terms of like an onslaught, is this like a new trend? Is there another shoe to drop? Not obviously. So in 2008, when the biggest one happened, there was that, and then there was like almost $100 billion in 25 other banks. So it was more widespread that what happened. In this case, where I would say, in 2008 it was broad. In 2023, I think the bank failures are much more narrow. And when I say narrow, I mean these three banks had certain things in common. First was that they were particularly vulnerable to rising interest rates. So they had long-term obligations when they took their deposits, and they either invested them or they lent them out, and they committed to low interest rates for a long period of time. Then when market interest rates went up, the net present value of those assets went down. And so it really, with Silicon Valley Bank, which was the first one to really have a big problem, there was investor concern, there was social media criticism. To create liquidity, they sold some of their investments at a loss because interest rates went up and those investments were locked in at a lower rate, and it started to run on the bank. It was loss of confidence, and so whereas in 2008 you had kind of a broad concern of the economy, you had large scale credit risk. So I would say the other difference here, we had real credit problems. In other words, the loans that banks were making and the assets that collateralized those loans were faltering. So there was like regular economic problems for banks in 2008. In 2023, it's actually not the case. In 2023, it's a lack of confidence. So I'm going to go ahead and use the word faith here, that people lost faith in these banks, again, because they had a few things in common. So longer term obligations at very low rates. So their balance sheet was upside down. They also had a high proportion of customers who had deposits in the bank that were way higher than what is insured by the Federal Deposit Insurance Corporation or the FDIC. So if you have a bank account, up to $250,000 in that bank account is guaranteed, insured. If the bank fails, you're covered, and you know that you're covered. By the way, it makes sense to talk to your bank about this because it's $250,000 per person, per entity. So like if my wife and I, we don't have that kind of cash sitting around, but if my wife and I had a joint account, we would both have $250,000 in coverage. So it makes sense to understand how much you have in terms of overall coverage if you get to a point where you have more than $250,000 in the bank. But in these cases, these three banks had a lot of customers that were way over 250,000. So when they had those problems, when this loss of faith happened because of these narrow issues of assets invested at low rates over a long period of time, and then rates went up. That loss of faith meant that those who had uninsured deposits didn't want to leave their money there, so they pulled their deposits out, made their balance sheet upside down, and the banks failed. So you start to see where it really this set of circumstances, these three bank failures, don't match up to Washington Mutual and the other 25 banks that failed in 2020 or in 2008, because that was broad. This is narrow. That was a real credit problem. This was a lack of faith in the industry. So I think the answer is, for now, unless something else changes, yeah, I think so. I think we are done, because the Federal Reserve took pretty aggressive action. If you're an investor in these banks, bondholder or stockholder, you lost, but no depositors lost anything. And so I think depositors generally should come out of this pretty confident that there's a strong system and a backstop to that system that didn't leave anybody high and dry, again, except for the investors in the bank and these banks that failed. So unless something else changes, I do think that we're entering into a period where this kind of short-term concern, loss of faith, run on banks, it seems to be mainly contained to these three institutions. Now, moving forward, there are some economic concerns on that are on the horizon. Rising interest rates to combat high inflation, but the inflation is pretty sticky, and the core inflation is staying higher than comfortable. Come down some, but higher than what we'd be comfortable with. That has created a scenario where the credit risks and these broad concerns, they'll pose some challenges for banks. But at this point, I think banks are very confident in the credit quality standards. So the people that they've made loans to, businesses and individuals, the credit quality and the strength of those customers is holding up pretty well so far in the economy. We would see a big downturn. Obviously, this type of scenario becomes more of a concern. But really, there's nothing in the economy right now that is pointing to a 2008 type of a scenario. So this question, are we done? For now, yeah, I think we are. I think that there's reason to be confident. Now, if there's a couple of recommendations I could make. First is stick close to your financial institution, your lender, the institution, the bank that you get your loans from, or the majority of your loans from. I think while they're worried about these narrow issues, liquidity, short-term loss of faith, and some of the banking systems, the role that social media played in the run on these banks, I think that banks are going to be looking to improve their liquidity position, which means pulling back on lending and borrowing somewhat. And I think a logical place for many of them to go is they're going to take care of their current customers, and they're not going to be particularly aggressive on going out and finding new customers for a little while. So make sure that you keep your relationship with your local banker close. And then the other thing that I'd recommend that you do is just understand the coverage that you have. So it's $250,000 in FDIC insurance for an FDIC insured institution. There's a different government backing, but essentially the same type of treatment for credit unions. So if you were to just want to go over and review that with your bank, they'll be able to analyze, with everybody in your family and your assets, your different businesses, what your overall coverage is, so you can just get an idea of where you stand. So a couple practical things that you can do in the meantime, but for now, I'm feeling pretty good that the problems that we've seen so far this year in the banking industry are narrow and connected to a loss of faith in some very particular banks that investors and depositors had, but the overall situation doesn't look anything to me like what happened in 2008. And so I'm feeling pretty good in the short term here that that it will be kind of a status quo in terms of the financial industry itself, as we kind of sit at the edge of our seat in terms of what happens with the economy. As we see a lot of warning signs, a lot of indications that there could be a slowdown. We're hoping for a soft slowdown and not a harsh slowdown. Stay tuned on that.